Imagine buying a stock that skyrockets, only to sell it too early out of fear, missing out on substantial gains. Or, holding on to a losing investment, hoping it will rebound, but it never does. Welcome to the world of finance, where smart decisions can make you wealthy, but emotional ones can lead to financial disasters. Have you ever found yourself selling stocks in a panic during a market downturn, only to see them rebound later? Or perhaps you've held onto a losing investment for too long, hoping it would turn around, but it never did. These are classic examples of emotional decision-making. When it comes to investing, many of us think we're making rational, informed decisions. But the truth is, emotions often get the better of us. Fear, greed, and anxiety can cloud our judgment, leading us to make impulsive choices that hurt our portfolios. For example, imagine you invested in a stock that's been performing well, but suddenly there's a market downturn. Your emotional response might be to sell immediately, trying to cut your losses. However, this knee-jerk reaction can lead to realizing losses that might have been temporary. On the other hand, another reason investors make emotional decisions is due to the fear of loss. The fear of losing money can be overwhelming, causing investors to make impulsive decisions. This fear can lead to a phenomenon known as loss aversion, where investors prioritize avoiding losses over achieving gains. To overcome this fear, investors can set clear investment goals and develop a long-term strategy. By focusing on their goals and strategy, investors can reduce their emotional response to market fluctuations. Additionally, social pressure can also influence investors' emotional decision-making. Investors may feel pressure from friends, family, or social media to make certain investment choices. This can lead to a herd mentality, where investors follow the crowd rather than making informed decisions. To avoid this, investors can seek advice from a financial advisor or conduct their own research. By being aware of social pressures and taking a disciplined approach, investors can make. Another significant reason investors make emotional decisions rather than smart ones is the fear of missing out, or FOMO. This phenomenon is particularly prevalent in the age of social media, where everyone can see what investments others are making and the returns they're generating. For instance, during the rise of cryptocurrency, many people jumped into the market because they saw others making huge profits, without doing their own research or considering the risks. As a result, they ended up buying at the peak and selling at the bottom, losing a significant amount of money. Similarly, the fear of missing out. Let's consider a common scenario where emotional decision-making can lead investors astray. Imagine you've invested in a stock that has been performing exceptionally well, with steady growth over the past year. However, due to unforeseen market conditions, the stock suddenly experiences a sharp decline. In this situation, many investors might feel a strong urge to sell their shares immediately to cut their losses. This is a classic example of an emotional decision, driven by fear of losing more money. But, is this the smartest move? Probably not. Now that we've explored the reasons behind why investors often make emotional decisions rather than smart ones, it's time to take control of your finances. Consider the story of an investor who bought into a hyped stock without doing their research, only to see it plummet. Don't let emotions dictate your investment choices. Instead, take a step back, assess your goals, and create a well-thought-out strategy. By doing so, you'll be better equipped to make informed decisions and avoid common pitfalls, ultimately leading to a more secure financial future. In conclusion, it's clear that emotional decision-making can have a significant impact on investment strategies. For instance, fear and greed can lead to impulsive choices, such as buying high and selling low. To avoid this, investors should focus on creating a well-thought-out plan and sticking to it, rather than making decisions based on emotions. By doing so, they can minimize losses and maximize gains. Additionally, educating oneself on various investment options and staying up to date with market trends can also help in making informed decisions. Remember, a smart investor is one who balances emotions with logic, leading to a more stable and profitable investment journey.